Yeah, it's Sunday, June 22nd, a little bit before 5 p.m. Central Time, the best time. You know what that means, everybody? It's time for First Call. My name is Victor Jones, but you're not here for me. You're here for the big brain, the one, the only, Christopher Vecchio. Chris, how you doing, my friend?
I'm doing as well as one can be when they're sitting short oil and waiting for the market to open.
I would imagine, my friend. Anything happen over the last couple of days? I've been out traveling a little bit, just curious, checking in, Christopher. Anything happen I should be aware of over the last 3 or 4 days?
My base tan's coming, and I spent about 4 hours by the pool yesterday.
Wow. Wild developments, my friend. We were just trying to take some guesses here. We got a couple minutes before the open. 6,025 is where they closed them. They're indicating maybe another 35, 40 points, something like that. What's your best guess on how we open here?
Look, these are thin markets, but our parent company, IG, has the CFDs that are listed on their website for the weekend Wall Street, weekend U.S. tech, weekend oil, weekend gold. And if we take those at face value, which granted, those are thin markets, low volumes, not American traders, okay? It looks like we're looking at an open of about 7.5% to 8% higher in oil prices, a little over 1% higher in gold, and then conversely, just over 1% lower in stocks. So will this be a limited set of action, Victor? No boots on the ground, as we've been hearing all day long in the Sunday shows. Perhaps the market doesn't take it too poorly. But all eyes are on what happens with the Strait of Hormuz, right? Will we see closures there? There's been credible satellite imagery all day long of ships sailing through the Strait of Hormuz only to turn around and go the other direction. So we will see how this obviously plays out. But if this is something that is limited in nature, which there's no guarantee that it will be, I would point to what happened in March 2003 when stocks were up and bonds were down, gold was down when we bombed Baghdad. So the next 24 hours, 48 hours, obviously will be the deciding factor for how markets view this latest. Well, I guess it's not a taco trade, Victor.
Yeah. I'm curious, Chris, like if you were to see something like this, clearly I think we all expect a certain move in crude oil as we near $80. I know you've been nibbling just a little bit on the short side because that's been the move for most of this, for these geopolitical tensions that traders for the most part have been fading spikes in crude oil. That hasn't paid yet in crude. If we were going to move to the upside here, nearing $80, how do you feel about crude now?
Well, I'm already short. So if I like shorting it at 76, I must love shorting it at 82. Where it looks like we may open. No, it's not going to be a comfortable position. I'm just hoping that the bonds and gold offset what will be a painful crude position for me in just a few minutes' time. That said, though, volatility when it spikes up here, if you stick with the broader range, we were looking at this last week on Futures Power Hour and Overtime. The 1 standard deviation move for oil, if you're doing something like a short iron condor, the guts of that was up near 90. Okay, and so we are still within the expected move right now. It may be an uncomfortable open, but that's why watching the news flow here, escalation in Strait of Hormuz matters so much. Because if the Ayatollah, who has ultimate authority over this, and I suppose we should be asking him shortly whether or not he plans on closing the Strait of Hormuz, Victor, if they don't close it, then oil is going to give up a lot of what's come on the board here very, very fast.
All right, we just opened up. S&P down about 0.4%. The NASDAQ down 1%. Crude oil opened up a little bit more than 5.5%. It's faded.
Not bad.
Just a bit, up 4.75%. Bonds have not moved. Surprise, surprise. We're up basically 2 ticks across the curve. Bitcoin has been fading basically all weekend. We're down 3%, just shy of 100,000. And gold, a little bit less than your 1% up prediction, only 0.2%. And silver effectively has not moved at all. Are you at all surprised? Is this fairly muted relative to your expectations, Chris?
Yeah, I mean, when we look at the week in Wall Street, again, that caveat of it being a thin market applies, and they're not American traders. So we're a little bit in from there, but directionally correct. Oil is, well, it's only up 3.9% right now, and we opened up closer to 5%. And I think that's going to be the bellwether here for today. Ultimately, Vic, that volatility, we're going to have to see how it evolves over the course of the session. We close out Friday with, what, an 86, 85 IVR, I think. And if you get another spike here, but oil staying below 77, I'm looking at my positions right now. I don't feel nearly as bad as I thought I would. That's great.
Vol up to 22 in terms of VX and 25 contract, up 90 cents or so. Do you think if I would have asked Tom this question, he would hate me? But what do you think about what Vol is signaling here at 22? It's a magic number for me. Tom would say it's the best number. I think him and Tony love trading in the 20 to 22 range, where volatility is historically overpriced, but you're not trading a market that's giving you a ton of outlier moves. So they really like 20 to 22. What say you about this this range of volatility?
I think you and I are both on the same page that when the VIX is sitting closer to like 18, 19, that's really the gray zone where you can go either way. But when you start to get into that 22 zone, that's when it becomes a little bit more appealing to just kind of sell the vol. That is above average, historically speaking. I would point out the shape of volatility curve. The volatility curve term structure matters a lot here. And as I'm just spot checking this right now, it would appear that as we go out in time, there is a little bit less contango. The curve's been flattening out over the past few weeks, and it appears like we're going to open with a flatter curve than we did on Friday. That's not to say that the market's in trouble, right? We're not seeing that the backwardation yet or the inversion in the front month. The fear is really not there. The VIX 3-month minus 1 month spread isn't in that terrible territory of 1.15 or higher yet. The market, as it were, is wearing this pretty well, I think. And we are going into a month of July where if we can, this is a limited strike. We're bombing for peace. I think I saw someone say we're bombing for peace, and this is a limited course of action. Stocks probably don't care about this because, again, how much revenue does the S&P 500 derive from Iran or Israel, for example? Nothing from Iran, minuscule from Israel. This is not a factor for corporate earnings unless there are significant knock-on effects for global trade, which is, again, Strait of Hormuz.
What do you think about, we're just shy of 6,000 now. We were just above 6,000, but we're at 5,980. Is there any part of you, year to date, I think the NASDAQ's up like 3%, the S&P's up 1.5%. How do you feel about the value to be had here in either the overall market or any individual securities or themes?
I think if we look at the AI basket, how it's performed versus companies that don't have that AI bent to them at the margin, right? They've done really, really well here over the past several weeks, particularly since the April lows, and they've outpaced the broader markets. So thematically, if we're looking for a leadership group to the upside, I don't think that we should shy away from AI. I would argue that probably a lot of the materials and commodity companies, a lot of the names that you like, Victor, that would be subcomponents of like GDX or GDXJ, they probably are the ones that are going to face the most difficult period moving forward, particularly if stocks trade to the upside. Gold on the long side is an exceptionally crowded trade right now, despite being in that boat myself. Short dollars is an exceptionally crowded trade there right now. Sentiment is the worst it's been since January 2005, according to the Bank of a Manager Global Fund Manager Survey. So if you enter a window where maybe gold comes off, I would argue that the stocks that are most overvalued would probably be the miners. And then those that are undervalued, I still have to think the Russell. And I'm talking my book there a little bit because I do have some out of the money calls in play right now. But the Russell, to me, if yields are starting to settle in and you're looking at growth right now for the second quarter north of 3%, the Russell companies could be poised for a period of catch up. So I think the value may be in small caps and the overvaluation probably in the miners, as it were.
I think that, do you think you get to a 3% growth rate? Do you think it's real, or do you think it's a fake growth rate based on net, basically based on imports and exports, how, businesses are, let's say, front running or were front running in the first quarter tariffs, and the potential opposite to happen in the second quarter? Do you think it's real growth we're looking at, or just sort of a weird anomaly of a calculation in the second?
It's accounting. It'll be accounting for the second quarter. And then, maybe even in going into the third quarter, because we're kicking the can down the road. It's worth noting that deadline is in 2 weeks or so, Victor. right? So we're going to have to get an extension to the 90-day pause, and that's going to continue to shape consumers' habits, businesses' spending plans. But I think it's a lot of just messy signaling. Until there's a permanent path, it's difficult for any business to plan, long term.
There's no reason to keep track of those deadlines, those 90-day deadlines. There's no reason to keep track of them anymore. There was never one in the first place. You knew you can't do these size of deals inside of 90 days. They're just a tactic to try to time box the discussions and keep them sort of moving.
Well, they have to.
No way are we going to do any deals in 90 days, Chris.
We're entering a window with some of the news that's been floated about Vietnam, right? Like, I want to steel man this, Victor, as you like to say. Okay. Let's just take everything at face value. The goal of this is to disaggregate U.S. involvement or reliance on Chinese industries, right? It's to build more things here at home, particularly the items, goods, products that are sensitive for national security reasons. All right. If we think about it in those terms, what has been one of the problems? You and I have gone over this before with NVIDIA, for example, with Singapore. How on earth is NVIDIA buying enough GPUs in a single quarter that would outpace the entire energy production of Singapore in an entire year? Are they just putting them on the shelf? Are they building their own super AI that we don't know about? Well, that doesn't make sense. Where's the power coming from? They must be a pass-through, just like a Vietnam has been. Okay, so Vietnam may be facing down a window where, because of the timing of the China deadline and the 90-day pause for everyone else, Vietnam could have a higher tariff rate than China. That's totally counterintuitive and goes right against what the administration is trying to accomplish here. It would actually incentivize more businesses to work out of China than Vietnam. So yeah, we do have a deadline coming up, but it has to be extended lest you have these incongruities within trade that incentivizes people to do the very thing that the administration doesn't want them to do. Right
on. I love that breakdown, by the way. Let me ask you one more quick thing before we get Pete on here in first call. It feels like a throwaway question, but FOMC was last week.
Who?
You and I sort of FOMC was last week, the rate decision, and you and I joked just how inconsequential it was, sort of in text back and forth. Your quick thoughts on FOMC, the SEP, and the press conference last week.
Fed has no idea what's going to happen next. That's the clearest message we got. They have no idea what they're doing next. They may talk about wanting to cut next, but they really don't know when it's going to happen. And the tariff overhang is very clear. I think Powell's trying to signal to the administration, just give us a firm path about where the tariffs are going so we can kind of model out how this is all going to work out. Because again, by the Fed's own logic, tariffs are a one-time price hike. And then they are more concerned with the other side of what happens once that little bubble of inflation pops. It's what happens to real output, what happens to the labor market, because all of the data that we have available, including Trump's own 2018 steel and aluminum tariffs, suggests that because of the composition of labor in our economy, we have more steel consuming workers and businesses than steel producing businesses. And so when the cost of steel goes up, well, yeah, the steel manufacturers, we may see more employment there, but every other industry loses jobs. Okay, and then the balance is net loss for jobs in the economy. And that's what the Fed's thinking about, the labor market. So if the labor market starts to roll here and inflation isn't materializing in the manner that they thought it would, why aren't they moving? So if not July, then I would think it's going to be September. And even so, that still puts the market and the Fed basically in the same camp, 2 cuts this year. I think we should be paying more attention to the pricing for next year, which I think one perspective, as Ilya might say, right, the market's saying, okay, if you're doing less now, you're going to have to do more later to catch up. But also you could see that the market starts to get a little bit more aggressive after that May 2026 calendar deadline, because that's when we get a new Fed chair. And I think the market's operating the assumption that whatever happens with Powell for the next year, whoever Trump appoints will ultimately be going in there with a dictate to cut rates.
Yeah.
So
a rubber stamp.
Yep.
A rubber stamp for lower rates. Great stuff, Chris Vecchio. Hell of a way to start off the show. What do you say we bring in our first guest, Mr. Pete Mulmet? Pete, welcome to First Call.
Gentlemen, thanks so much. Fantastic. Fantastic start. How about it? We certainly have a change in the ground rules. It really is.
It seems like in terms of equities, the market is pretty well priced the potential for something to happen over the weekend, right? If you're going to strike, you don't want to do it while the market's open. You do it while the market's closed and let the market digest. But they're gobbling them up here. Only down 0.2% now, Pete.
They really are, and I'm a little surprised to see at the pace of what they're doing that at. So it'll be interesting to see how Teflon this, because it really is. I mean, where we are right now, we're back to almost 6,000 as FOOs and 22,000 NASDAQ. So it'll be interesting to see. This is a kind of a relatively small rounding. His potential, the problems are of any kind of retaliation, and then what next steps that takes. It's amazing to see the dip buyers emerge here, even though it's early, even though it's thin. And we talked a little bit before the show how, not quite sure will there be a more dramatic move, or will it be kind of this thin fishing around? But gold gave back $30 in 5 minutes. Interesting too is, Chris, you talked a lot about this too. If this is the best the dollar can do in terms of a safe haven bounce, it's pretty sad because it's about 30 pips lower than when we went off Friday in euro, and Aussie's almost back to unchanged. Yen's a little bit lower, but things like Swiss, which you would have expected on a move like this, old school Swiss would have been 200-300 pips higher, and you're just not seeing it. So bonds are another one. So I would have thought we would have, we saw mid 114s at some point last week before we kind of sold into it on Friday. Not much of a reaction there. So
are you surprised how dead of a trade bonds have been? Are you surprised at all?
You know what? I still think eventually we see. Yes, in terms of, I still think we see 110 before we see 150, 120, and I think we probe below that. I don't see them. I don't see them at any speed to take any action to lower rates, and I really think that when you look at. I mean, this is kind of unconventional in terms of the reaction that bonds are not a point and a half higher off of where we are, which is the lower end of that 110 to 120 range. 115 euro is rich by the last 5 years as standard. And the fact we can't get anywhere, well below that is kind of interesting to me in terms of just what the tape action is telling me. So, I'm a little bit surprised that we're not seeing more of that trade. I think if things like this don't get people, I guess what it tells me too is that I don't think there's an overly short bond market right now, or people are really not that concerned about the U.S. U.S. Treasuries as the safe haven asset they used to be. I mean, Bitcoin is back above 100,000. We got down to 99,000 early this morning. But yeah, I'm honestly, Vic, I'm surprised by the muted nature of all this right now. And it will be interesting to see. I mean, if I can't imagine, I guess if you just walk through the steps, I can't imagine them not responding in some fashion, and that reaction eliciting another response from us. And I think, Chris, you had mentioned at the end of the day, what's Iran's contribution to U.S. economy, U.S. markets? Nothing. I mean, holding oil hostage, yeah, but we're in a different oil market than we were even 5 or 10 years ago. So their ability to do so is relatively diminished, and it's more of a delay than a disruption of Strait of Hormuz. So, yeah, I'm a little bit surprised to see this. It'll be interesting to see that if the dip buying holds, and I've got to imagine if we go unchanged, it's going to be a surprisingly. It's not the move I would have expected. I would have thought we would have opened lower, come off of the extreme print, sat and kind of held in a relatively stable range. But I mean, this is dip buying, whether you look at SPOOs or NASDAQ or really even bonds. It's people willing to step into this a little bit. So a little bit surprised to see that.
Let me ask you, given that you just mentioned there's obvious risk of retaliation, and that can have impacts into how you think about crude oil, whether or not you step in and you fade it here, or maybe whether you wait to see how things play out. What would Pete Womack do with this? In the short term, what looks like a price extreme, but you could have said for the last week or 2 weeks that you're in a price extreme in crude oil as we continue to climb higher each session. What do you think about crude at 76 to 78? Do you like the fade here, or would you step away and let things play out this week?
For me, there's probably other things I'd be looking at. I think that's the thing that hangs over this. I mean, we're already down $2.50 from the highs in crude, which is I'm really surprised at. I thought we'd get that print $78.50, $79, and then just kind of sit around 78. But the amount of damage to do, we're within a nickel of putting in new lows for the night, back under $76. Surprised at how quickly the give back is coming, and that aligns with the bull rally in equities. So I think you've got to be mindful of what's the next shoe. Is the next shoe complete capitulation and some sort of negotiated settlement? I don't see that route, and I don't see this eliciting that route. I think that the next route is some form of retaliation, followed by what measured response or unmeasured response, depending on how you look at it, we do. And then where does that play out? So you can look at a $2.50 pullback in crude and think, if there is a response, that's an interesting pullback. But from its inability to hold on to any of that rally right now as we speak, really surprises me a little bit. So I wish I could give you a clear idea of what I want to see. But right now, I don't think this equity market rally holds. If it does, if we come in tomorrow morning, 5, 6 in the morning, and we're back anywhere between here and unchanged, we're probably going to have a higher day, irrespective of what comes. I think at this point people they're not quite sure what to do, and I think you're seeing the thinness now. But I'm surprised as to the amount of capitulation in tier 1 things like crude, like bonds, like equities. So it's a little bit surprising to me. I don't know quite what to make of it. I think if you go back to the kind of second tier movements within whether it be the dollar or some of the other metals, I think it tells you a longer term story that, irrespective of this, the dollar is not the safe haven product it was for the previous 30 years. And we probably see lower dollar levels, irrespective of what goes on. Equities, I think it's going to be a little bit tougher to see through.
Victor,
it's almost as, yeah, go ahead, Chris.
Yeah, I wanted to just chime in something before we lost it and got too far away from bonds. You mentioned it was a dead trade here, and Pete, you talk about the positioning in the market. I actually just ran the numbers. In October 2023, when we were sitting right around the current levels, the market was nursing a very large net short position of about 200,000 contracts by speculators, and that's as we were going down and down, so people are piling in. Right now, still sitting right around 113, 114. The net speculative position is only minus 10K.
Yeah.
So there's no strong pull on this market whatsoever right now.
Right. And I think that speaks to, for as long as he's there, it's going to be a measured Fed response. Any interjection of uncertainty, whether that be tariffs, whether that be the price of oil, that's going to just have them take a more measured approach until it starts impacting either side of the dual mandate. And we're not seeing that right now. We've got a slew of price data coming out this week. It'll be interesting to see if that is the canary in the coal mine. Are we going to see this tariff adjustment play through in any of the pricing metrics? Because it hasn't been delivered up to this point, and I think people are getting a little too complacent with that component. So for me, I am a little bit more mindful of. I mean, I think anything north of 6,000 is interesting from the short side and SPOOs.
What's the one before we get you out of here? What's the one thing like you have I don't want to call it the highest confidence level in, but just what do you think is the most interesting risk to reward bet on the table for the next week?
It's a good question, Victor. It's interesting, Chris. You're long gold. You're in for the ride, right?
I'm, strategically, yes. Tactically, it just feels very heavy right now.
Yeah.
What more could you ask for in the past 2 weeks? The data showing us that gold's become the second largest asset, second most held asset by central banks, right? The U.S. involvement against, we're up by 0.25% right now. You can't get up on this headline. And again, it's a crowded trade. So I regulate only being crowded trades.
And you're seeing them, things like platinum that have been an absolute dog over the last 5 years. Platinum over the last 20 years sat between $500 and $1,000 a premium above gold. I mean, we have been wrapped around $1,000, $1,050 for 8 years. Yeah. And I mean, certainly we had by far, this was the outperformer in the metal space last week. It'll be interesting. Things like this, if gold is actually going to still be able to hold in and not lose its luster, actually, one of the things I've been looking at is buying some platinum, selling some gold calls here, because IV is still relatively high. And I think platinum may have some more room to run if metals continue to outperform. And they are the chosen place to park. I still think equities are, I don't think these rallies hold. And I want to be a seller. So that's where I'm looking. Dollar is, I mean, everything from a technical perspective you look at, if the dollar can't build on any strength here at these levels, and again, we spent all last year between 103 and 106, briefly touched 117 in the SEP futures. If we can't build any real downside energy in what I think some of us could argue is a crowded trade, big short dollar here, maybe the next trade is a little bit higher.
Pete Momet, always appreciate it, my friend. Appreciate seeing a calm face in a crazy world. Pete, any last words for the audience here before you get out of here?
No, that's it. It's going to be interesting.
Meaning the Forex Focus show and all the things you're working on with Forex. Any announcements for the people?
Hey, if Forex Focus every day at 6:30, it's great if you want to learn trading spot FX markets. FX is now available on the platform, as Victor has there. You scroll down to the Tasty FX tab. You can open that market up and start trading spot FX. There's a lot of content on the website if you want to learn more about it and how it works. You want to trade Israeli shekel, it's there. Now, albeit it's wide, but you want to, which is really interesting that the dollar shekel rate, which actually had a huge spike when the war started, that shekel weakness has all been taken out of, put back into the shekel and out of the dollar very recently. So there's lots of interesting pieces on the Forex side, different way to trade the markets, new product set, exciting stuff.
Awesome, Pete. Thank you very much, my friend. Running anchor here, Ilya Spivak. Ilya, how you doing, my friend? Welcome to First Call.
Gentlemen, all good. Watching the markets and scratching my head along with the rest of the world. And if nothing else, happy that I flipped over my dollar position from heavy short to modest long on Friday.
Scratching your head. Explain why. Expand on that.
Well, I think what we're looking at is not what a lot of people are talking about as far as kind of how this is going to shape up. I think, and this should not shock you, I'm of the perspective that pretty much everybody that's been talking about it is wrong from both sides, because one side is saying this is fine, this is okay, this is a one-time strike, there's no adversary of any consequence on the other side. In terms of conventional military, that adversary has had all of its proxies defanged systematically over the past year. That adversary doesn't have its big nuclear friend, Russia. If Russia wasn't going to come to the help of Armenia against Azerbaijan, a very small conflict, they're definitely not stepping into this one. And they've made clear as much. So one might say, okay, this is a localized thing. It tips the balance. This is not a big deal. I don't agree with that perspective. And then the other side says this is World War III, hide your kids, hide your wife. I don't agree with that perspective because you don't have that kind of an adversary on the other side. This is not the U.S. versus China. This is not the U.S. versus the Soviet Union. There is not that kind of adversary on the other side to think that's what's happening.
It's not World War III in the World War I and World War II context
Correct.
and framework.
Correct.
But it's
Correct.
World War III. But it's World War III.
Agreed.
So what we're looking at, I think, is much closer to what was the Iraq War model, where it looks like you have a quick win and then you get stuck in the mud for a really long time fighting an asymmetric enemy. And what concerns me more than anything is that, unlike Iraq, Iran has a tremendous, wide, broad international network of non-state actors of all kinds in all kinds of places. And what retaliation can look like here doesn't have to be standard military. It can be something completely left field, and it need not be anything that we think is over there and could be much closer to home or to European capitals or to allies' capitals in the region. And so, in my mind, this is not over by a long shot, but it isn't a war on the battlefield. And so my concern is that this is going to look like a quick win for a bit and then not go away for a long time.
Where when you see prices, whether it's equities, whether it's the dollar, whether it's volatility, crude oil, gold, silver, Bitcoin, where do you see opportunities given current price levels?
Well, so I mean, no secret, obviously, that I've been sitting on the short side of equities basically for the past month and a half. And obviously, I got in way too early, fading the bounce, but I think it's starting to finally kind of round out here. And we're starting to get a little something. But the most interesting thing for me, because, of course, fighting equities that want to go higher is, I can speak from experience to say this is a painful thing, even when it seems like it makes sense. I still think the risk reward is on the short side, but I think the more interesting thing is the dollar. I think to Chris's point, this is incredibly crowded now. And what the Fed and the markets seem to disagree about, again, is the Fed clearly seems to be pulling in a less hawkish direction. They actually took a rate cut away from the SEP last week. And the markets not only didn't take it away, they've got 60 basis points for 2026 now. I think Chris is exactly right, and he and I talked about this last week. Mm-hmm. It's not about speculating on this year. This year is a done deal. The calendar is already telling you, much like it did last year when the Fed said, we're doing 100 basis points in easing in 2024. Here's 50 basis points up front. There's 2 more meetings left. You figure out when the cuts are. The calendar is telling you. I think you're getting to that now. You're obviously not going to get a cut in July. That much is clear. There's no meeting in August. Okay, so in September, you do one, or in October you do one, then you do another one at the last remaining meeting. Otherwise, you have no more space. So the market is looking at this and going, okay, you're going to do the 2 you said. You've already talked your way in there. That's done. The more interesting thing is, what are you going to do next year? And the markets and the Fed are clearly at odds there. The Fed's got just 1 cut. The market is approaching somewhere between 2 and 3. So I think this is now a kind of give and take. And if this means that the dollar is going to have a yield advantage against all of these currencies for longer than expected, even before the geopolitics, the dollar short looks like a thing that's crowded. And so I think it's starting to roll over. I've gotten modestly long against pound, Aussie, and euro, and the Canadian dollar.
There you have it. Chris Vecchio, I guess final question. As we round out the show here, any thoughts about defense stocks going into this week, given what's just happened? Have we reached a peak here? Is this sort of the buy the rumor, sell the event type of situation? Or do the events that just happened, do they sort of create a catalyst for additional spending, additional contracts, additional defense? And do you see additional hire for things like Palantir, some of the more traditional defense companies?
Well, let's take a step back. Saying that we're in World War III is a pretty irresponsible thing to say, but I would posit that we're expecting World War III to be something conventional where troops land on the ground and line up and shoot at one another, reinforced by artillery and air force. But when you look at what's going on in the state of the world right now, there's a conflict in Eastern Europe where the U.S. and its allies are supplying one side, and Russia, China, North Korea, and Iran are supplying the other. There's a conflict going on right now between Israel and Gaza, Israel and Iran, where the U.S. and its allies are providing missiles and weapon platform for one side, and then Russia, China, North Korea, Iran are supplying supplies for the other. We can go to the U.S., Iran directly, but let's look at India, Pakistan. Who provides India their weapons platform? The U.S., France. Who provides Pakistan their weapons,
by the way,
and Israel. And who provides Pakistan their weapons platform? Russia and China. So maybe it's Cold War 2.0 that's become hot in a number of places. And there were about 14 hot conflicts during the Cold War, the original one, where the U.S. and Russia were lined up, or rather the U.S. and the USSR were lined up on either side, either directly or indirectly, providing arms and support. And maybe the U.S. was invading somewhere and Russia was providing arms to the communists, or maybe Russia was invading somewhere and the U.S. was providing arms to the Mujahideen, right? How does Osama get his experience after all in the 1980s, pushing back the USSR from Afghanistan, supplied by the United States of America.
And trained.
So, Victor, the question is, if we see a pullback this week in defense stocks, is the world getting more or less dangerous? I would point to what's happened in Turkey here. You have Recep Erdogan, their president in recent days, looking at what happened to Iranian air defenses, their S-300 systems, which, again, mind you, that's the Russian defense platform that Russia uses to defend their territory from Ukraine, so it's all the same story. Turkey's now making another big jump in their military spending for drone defense, for long-term missiles, because this is just how the world is right now. Unfortunately, the business of war is good business, and that's capital spending that will not be cut in the event of a recession. Governments always find money between the cushions to tax their citizens for weapons of war.
Corollary to that, by the way, since Turkey is rearming and is a member of NATO, you're seeing the capitals in continental Europe very quiet about the fact that Erdogan has just jailed in recent weeks his most prominent opponent in the upcoming elections. Normally, this would be a very loud outcry from Brussels, from France, from Germany, from the UK. No outcry, because, of course, the physical troops in NATO are very skewed to Turkey. And while you can build all kinds of weapons, and they certainly intend on it, there's the suspension of the German debt brake for defense spending. There's the European Union talking about 800 billion in spending. The first 100 billion is already on the books. It's been signed off on. So they're going to spend a bunch of money on defense, but that's on technology, that's on armament. Who's going to drive the tanks? Who's going to sit at the cannon? The troops, the size of personnel is in Turkey.
Beautiful. We covered a lot of ground here today, gentlemen, and we did it in a nice, tight show. Ilya Spivak, Chris, it is always good to get the old band back together. Chris, I'll give you, normally I throw it over to Tom to give a final word for traders at the end of first call, as you are sitting in for the man himself, I'm going to throw it over to you for a final word, either on an individual market or just mentality, psychology going into the week, my friend. Would you do me a favor?
Sure. I mean, I think mentality-wise, it's a continuation of what was discussed last week, which is that when volatility comes in the market, when you saw the IBRs below 20 in the S&P, it's a good time to pull back and ultimately get capital ready for when everyone else panics. And I will tell you at first, I'm a little bit surprised. I think Tom and Tony might say they would be as well, that the market is not weaker than it is right now. But that just bears mentioning. If you stay small, contained within your mechanics, you'll ultimately be able to roll the dice and put a trade down when the time is fit. So maybe that's tonight in oil. I'll tell you what, I'm feeling a lot better because I'm staying within my mechanics, Victor. The short call spread I put on oil last week, thanks to this heavy vol skew right now, was 76.78. So it's down tonight, but I was expecting a move that was way out of the, all right. But by staying,
you were expecting to be fetal position under your desk, pray.
Yeah. Yeah, like I asked my wife tonight, like, honey, I'm short oil. What do you think's going to happen? She goes, I don't know what you do.
That's how you know. If you're in deep, you know what. When you finally come out of that home office and you go, okay, honey, I got a big problem. You talk through your positions with your wife.
We might actually have to take physical delivery this time, honey.
All right, everybody.
My
Thanks
wife's
for tuning
Queens.
in.
She doesn't let that conversation go longer than 2 syllables.
In early April, my wife came in. She saw me in my office and she goes, hey, what's going on? She could tell. Thanks everybody for tuning in. Sincerely appreciate it. Hit the like button before you get out of here. Subscribe to the channel if you haven't already. Programming starts bright and early, 1:30 a.m. Central Time. So no matter where you are in the world, Tasty Live has got you covered. So whether you're in the U.S. and you just can't sleep because you're a degenerate like the three of us on camera, tune in to Tasty Live. Or if you're somewhere else in the world, we've got you covered as well. So 1:30 a.m. either on tastylive.com or through this YouTube channel. And also make sure you go to tastylive.com, subscribe to Tom's Cherry Bomb, which will be dropping in a few hours as well. Goodies for everybody. Ilya, tell the people when you'll be on tomorrow, and then Chris will end with you doing the same, and we'll get out of here.
Actually, Chris and I are going to be doing the dance together a lot
whole day.
Tomorrow. We'll be on Futures Power Hour. Then we'll be on Overtime. Then I'll be on Macro Money as ever, Monday through Thursday. And then we'll finish it up at the end of the week with Futures Power Hour on Friday. So if you want to hear how this conversation continues, of course, both of us will be on with you, Vic, for the Price of Truth Tuesday and Wednesday. So we're going to be talking, the three of us, all week long.
My man. Special thank you to Frankie in the chat as well. All right, fellas. For myself, Victor Jones, for Ilya Spivak, for Chris Vecchio, for Pete Molmat, and everybody behind the scenes here at Tasty Live, we thank you very much. We'll see you back here bright and early, 1:30 a.m. Central. Until then, peace.
Peace.